Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome, everybody. Thanks for being with us for another episode of Something More with Chris Boyd. I'm Chris Boyd. I'm here with Jeff Perry. We're both of the AMR team at Wealth Enhancement, and glad to have you joining us. Well, Jeff, just for those who listen by podcast, I was laughing as our show opened with video, which is available on YouTube or on our webpage. You can reach it by going to somethingmorewithchrisboyd.com. I noticed in most of those pictures, all the other team members are wearing like sweaters, and Jeff's always got his short sleeve shirt because he's coming to us from Florida.
I do.
Sunny, warm Florida all year round. And nowadays I'm like, hey, I'm feeling like it's warm here. But anyway, just made me laugh because I was noticing the discrepancy in that.
I'll have to check it out on the next episode.
Yeah. So anyway, thanks for being with us. We're going to talk a little bit about IRA milestone ages today. These retirement plans, some milestone ages that are relevant.
There's more than you think.
Yeah, you'd be surprised. So there's lots to review, but and there may be some opportunities for you to be thinking about as you listen today. There's a lot of relevant considerations either for money in, money out when it comes to making use of retirement plan IRAs, and some of this will be related to other things too. 403Bs and 401Ks, etc.
Sure.
So, Jeff, I was going to start at age 21, but you actually said you had a better suggestion for where we start.
Yeah, it's almost like a trivia question. When can you open, at what age, an IRA?
At what age can you open? It sounds like a riddle, or maybe Karnak,
Yeah, exactly.
When can you open an IRA? Is there a minimum age?
There is a qualifying event, but I am not aware of a minimum age.
There you go.
So most people might say, "Oh, I don't know, 18."
You would think it would be
right?
when you start earning income. What's that? 15, 16. When you actually get paid with a W-2 or something along those lines.
Well, you are correct. That is the qualifying event. When you have earned income, you can contribute as much as you make up to the limit for someone who's that age or any age. So
yeah.
You can put it in an IRA. So if you have a 16-year-old who gets their first job and makes $7,000, they could put it all in there.
Right, yeah.
It's not going to happen, but
or
mom
and dad or whatever could contribute the $7,000 that they made.
Sure, they can. Right. It doesn't have to be directly
fund it.
Yep.
But this comes up because sometimes people who own businesses seem to employ their 6-year-old or whatever.
Yeah, that might be pushing it. I'm not an IRS expert, but they might have a 12-year-old, right? Who
could be doing
maybe it's a restaurant and they pick up the trash in the parking lot and they
reasonable.
Or whatever the tests are, they earn their income is the qualifying slogan there.
Yeah.
And think about if a 12-year-old socked away some money in an IRA, and
boy, that could really be relevant over a lifetime, right?
Even if they just left that initial funds there, it would grow.
Let it compound. Deferred. Yeah. Boy, that'd be nice. Well, I think that's the motivation why some families do that. But all right, so potentially any age that you have earned income,
right?
You could be contributing to your IRA, Roth IRA. Very good. Well, all right. So we don't even have a number for that one, but
No,
early,
early.
early and often, right?
That'd be great.
So, all right. Here's the age 21 is an age to be aware of, and this is a little bit of an oddity. Like, why age 21? You think of IRAs and you think much later, right? For relevant ages. Well, the issue here is if you have someone who is an eligible designated beneficiary, which means that if they're the beneficiary of an IRA, an inherited IRA,
Right. Someone's passed away.
someone passed away, and they're a beneficiary that they could receive their portion, their beneficiary into an inherited
Mhm.
IRA account. And let's say, for example, they're a minor, but
Sure.
the decedent was a parent who was over the age of 73 in this case, who
In
had
other words,
had
they were
had, rec-
taking.
had begun their RMDs.
Right.
They had passed the required beginning date, and that's so. Those are rare occasions where you might have a minor who fits into that category because it has to
Could
be
happen.
their child, might be a stepchild,
Adopted.
adopted child. There are various circumstances, but it's probably less frequent. So in any case,
Right.
but in that instance, once that minor, so it starts off where it's like they're on um an IRA that they could have had over their lifetime type of calculation. What do they call the stretch
Right.
calculation? But once they hit 21,
Yep.
the clock changes. Now they've got that 10-year rule requirement that happens for anyone else who might be in the Secure Act time frame. You know, you receive this beneficiary IRA in 2020 or after. You have usually 10 years, but
Right.
so that minor ages into going from the stretch and then has to go to the 10-year clock.
Completed within 10 years. Doesn't have to do it in 10 years.
Exactly right.
Right.
Doesn't have to do it in 10 years, but has to complete it within 10 years, right?
Right.
So that's an unusual one. You don't probably come across that too often. Let's go on to some other ones that might be more frequent, but these are still less common. The next age is for age 50.
Hmm.
And the first reason age 50 is relevant is because this is when you can start to consider being eligible for catch-up contributions
Sure.
to add to your retirement plan or your IRA. And just while we're on this, there's a whole series of nuances, right, with the catch-up contributions.
The super catch-up
Yeah,
contributions.
that started this year,
It
right?
did. Yep.
So there's some other ages in that. Maybe we'll come back to those. But anyway, first reason is for eligible contributions for age 50.
Yep.
So these catch-up contributions. The other reason age 50 is kind of an interesting and relevant age is in certain circumstances for public safety employees,
All right.
you may qualify for an exception to the 10% early withdrawal penalty. You sounded like you knew a little bit about this, Jeff. You were mentioning there are some kind of specific rules around it.
Yeah, it's the same exception that some 403Bs and 401Ks have at 55, but it's a 5-year advance because you're in a public safety hazardous profession that you typically retire early. And so if we can put maybe both of those together and just note that it's 50 for public safety and 55 for other folks. And that allows you, if you retire and like you're retired, this isn't a job change, this isn't, you're actually retired, you are allowed to calculate a payment over your life expectancy and take that amount each year. It's a irrevocable decision. You can't like say, "Oh, I'll do it now because it's 5 years early and I'll change it later."
Right.
And so whatever that calculation is based on your life expectancy, you take that amount annually, and you're not penalized the 10%. You still pay the regular income taxes if it was pre-tax money and all those things. It's just it's a exception to allow you to avoid the 10% penalty at 55 for most people and 50 for public safety officials.
All right. So get specific, get granular in the rules before you go down that path. But there are some windows to be aware of.
Not just the rules, but that's a long time to stretch. Not to, I don't want to
Yeah,
inappropriately use that money, but to use that money to have
over
it last.
retirement. Yeah,
know?
you may not last. Yeah, that's a good point.
Right.
That's a good point to think in terms of life expectancy. And sometimes people have reason to think they may not live a long lifespan.
Sure.
And if you have legitimate, like real health concern type reasons,
Right.
That's a different consideration, right?
Or maybe not a spouse specifically, but heirs that you're worried about, right?
Good point.
Yeah.
But if you do have good health and spouse, kids, and so forth, I mean, to think you could be living as long or as probably longer than your working years,
Sure.
Potentially in that scenario.
Sometimes people, just talk about public safety because they have the experience with it, but sometimes you're just not able to do the job anymore physically.
It's a good point.
Without a shorter lifespan expected, but it's just not safe for you to do the job, or you're not able to. Firefighters and
you can see
think
that
about
as an example, right? Yeah,
Yep.
very, and I'm sure there are other circumstances where, for a variety of reasons that could happen.
Right.
Yeah. Good point. That's worth thinking about. So, all right, another age is 55. This is a similar kind of circumstance. Go ahead.
It's pretty much the same thing, but for people with traditional employers, 401ks, 403bs, and you're able to do that scenario at age 55.
Yeah, so the exception to the 10% penalty, withdrawal penalty for qualified plan, recipients or participants, not IRAs.
Right. So don't roll it over if you're going to do this.
Right. That's a good point. If you leave your job, whether you quit, were laid off, retired, any of the above, right, in or after the year you turn 55, you can take distributions from your employer-sponsored plan without incurring a 10% penalty. Again, this is one of those instances. If you're an owner of the company, there's some specific rules here too. You can't finagle the system with that kind of thing.
I think that's 5%, right? And so even a real minority owner.
Yeah.
If you have ownership in that entity that's paying you.
Yeah, I think there's some rules against playing the system, and that'll come up again a little later. We have some additional rules relating to that. And so the next one is probably one most people would think of as a relevant age, 59 and a half.
Well, that's when you can take your IRA or any of your retirement plans and start to take the benefits of it, pay the taxes, obviously, if they're due.
Yep,
Traditional,
no penalty.
No penalty.
This is when it's intended, I guess,
right.
Say.
Yep.
And you don't have to worry about any of those special rules. Okay. Now, we had talked about some of the other catch-up.
Do you want to go back to the new one? The super one? And I'm not just being funny with that. I think that's actually the name.
Yeah. So if you are participating in a 401k or 403b, for example, if you in 2025, this is the first year it's applied.
Yep.
For those who are age 60, 61, 62, or 63 at the end of the year, as of December 31st, you have to still be those ages.
Whatever your age is on December 31st.
December 31st.
Yep.
Okay. You can contribute an additional $11,250 instead of the $7,500 catch-up contribution. So you have this window where you can do an extra.
Right. Extra. Super
extra.
It's a great option for people who haven't saved enough and they're still working and they have the cash flow. Put it aside, plow it in there.
Absolutely. And I think for simple IRAs, you have the option to add, if you're over 50, you can do $3,500 more than the 16,500. So now 3,500 extra. But if you are age 60, 61, 62, or 63 at your end, you could instead contribute 5,250. And I'm blanking on, here it is. There's one other exception. For 2025, the catch-up contribution limit for someone who works in a business with 25 or fewer employees.
Okay.
Those people can do 3,850 instead of the 3,500.
Okay.
So there's all these exceptions. They're all good Lord, right? Okay.
There's a subject product of a negotiation.
Yeah, exactly. Right. So that somehow got snuck in there, right? Yeah. All right. So your Chamber of Commerce may be working.
Yeah, somebody.
So that brings us to maybe age 62.
Okay.
Age 62 is the last year you could consider doing a Roth conversion without it impacting your IRMA, the charge of the Medicare premium calculation.
Right, because it's
for Part B and D, because there's a 2-year look back.
Right. So when you go to apply for Medicare at 65, the Medicare administration looks back, Social Security Administration looks back.
Yeah,
and
at
sees
your tax return.
Right, when you were 63.
Yeah.
And if your income is whatever your income is, directs your premium for Medicare.
That's right.
So if you had a big Roth conversion at age 63, and it appears to Medicare that you
use your income, huh?
And you're going to be paying, and you can fix it later, or you can appeal it.
You may be able to appeal it, but
if you create it
with your numbers, and that's going to make you frustrated. And this is one of those things that people go crazy about.
Well, they go crazy because they don't know about it. Because they're in this age of early 60s, and they're making all these what they think are great moves for their retirement, as they're approaching it, and they're not getting any advice, so they're just like, I should do this, and nobody tells them, if they're just calling their brokerage account and saying, I want to convert this and that, and they just say okay. And then they file for Medicare, and their premium went from what they thought would be $100 and some a month to the $700 a month, or whatever it is, because it looks like they make $500,000.
Right, because they had this big conversion.
Right.
Yeah, exactly. So that's one to watch out for. And of course, age 65, it's not really an IRA issue, but it's when you're eligible for Medicare.
Yep, and please sign up. We always say that when I hear Medicare. Don't. But we've had this so many times.
Yeah. Remember we had were you on the radio that time? Yeah.
I was. Yeah, we had our resident expert on the line, and
I think it was Marcia Mantell that time.
It was.
We've had Marcia Mantell and Kurt Zarnowski, both fabulous. Marcia Mantell was, I think, our guest that time, and some guy called up, huh?
An older gentleman.
Yeah.
Well, he was 65. He wasn't that old.
Yeah.
And somehow
he was like a couple of days away from his 65th birthday,
and he hadn't signed up and didn't realize that there's a penalty, if you will,
can have some lasting consequences,
right, for not signing up when in the window that you're suggested.
So fortunately, he was listening, and he called in, and she was like, "Get that resolved,"
Yes. Yeah.
But anyway, it's not on our list, but of course, 67. It might be a little. I think it's still for people today. It might be 66 and some,
I think
three
this some
quarters or something
66
like
is
that.
67. Yeah.
But typically, we're getting close to the point where 67 is full retirement age on Social Security.
Yep.
And we didn't say that was 62, but that's maybe early option for Social Security.
Sure. It's your first option that you should.
Yeah, but you
that
do get a lot
could
of
consider.
discount on your benefit.
Big discount.
30%, something.
Oh, we argued this before. It was 50. Remember?
Oh yeah.
Yeah.
It was one of these things where, depending on whether you're looking at it from the beginning of what it is.
It was a math argument, actually. I think we might have been saying the same thing, but we were doing the opposite math.
Different way of calculating.
Yeah. So it could
get
be
a big discount.
Could be half.
I won't let it be half.
Of what you could earn at the max benefit age, which is 70.
Right. I'd forgotten about that.
Yeah.
So, all right, the next big IRA age is 7.5. 7.5. This sounds like a mistake, doesn't it? 7.5.
It sounds like history.
Yeah, sounds like you're forgetting something. Things have changed. So it used to be, just for the history, at RMDs began at age 70.5.
Right.
And then they changed it to age 72. And then they changed it to age 73. So now, what's 70.5? So they kept 70.5 in the books because of that history as the age for qualified charitable distributions.
Oh, they forgot to include it.
I think it's been intentional because it's been twice now that they've either forgotten or ignored this change. But the qualified charitable distribution is an instance where you can send a charitable entity money from your IRA, and if you were subject to required minimum distributions, it would count as if you had taken a distribution, but you don't get taxed on that when the withdrawal, because it doesn't come to you. It goes directly to the charitable entity. The entity doesn't, charities don't pay a tax.
Right.
So the money that's pre-tax IRA money goes directly to a charity without tax and counts toward your RMD. So a win-win, right? That's what a qualified charitable distribution, how that works, QCD. But it's actually something you can start doing before you're even required to take a required minimum distribution.
Right.
So a nice, I'll call it a loophole that they've left behind.
Yeah. Well, if you were going to do it anyway and you itemized, which that's another tangent where you could go. A lot of people don't itemize, but it's a very efficient way in ensuring that you get the maximum amount of deduction, if you will, and the charity gets the maximum amount of the money.
Yeah. You'd pay more tax by taking the money, paying the tax, getting a deduction for giving it to charity,
right,
than if you just gave it directly to charity.
Right.
You end up you have no tax consequence, neither does the charity. And it's better for you. It counts toward when you have a distribution requirement, it counts. But so there's less tax paid by doing it through that fashion. Qualified charitable distribution, 70.5 or older. Now, when you have distribution requirements, now those begin at age 73. A required minimum distribution. We won't go into how this is calculated today. We've done that, I think, in the past, and it's always a question people have. So we're happy to address it if people do have questions. But the essence of it is each year, your balance is looked at, and based on the balance at the end of the prior year, look at the age you're going to be at the end of the year. They use a factor, and that factor is based on a life expectancy assumption that you, and presuming you had a beneficiary 10 years younger, or a spouse beneficiary 10 years younger, what's the joint life expectancy?
Yep.
And that's used to divide the balance by that factor to come up with the required distribution. So you will have to take distributions generally in the year in which you turn 73. It's based on the calendar year. Now, there are instances where people will choose to not take that distribution. You look like you were about to elaborate on that.
No, I was going to say if you were born before 1960.
Thank you. Good point. For those born before 1960.
Yeah.
If you had circumstances where you're working this year, but you're planning to retire, let's say at the end of the year, so you really didn't want the income from your distribution this year, you might consider pushing it into the next year, but you have to take it by April 1st. And remember that you also have to take next year's distribution next year.
Right.
So now you have to double up. But there are some, occasions where people want to do that. But generally not recommended. Just as an aside, had an instance where someone was rolling over a work plan. And this is probably important to remember for people. If you're subject to an RMD, they want you to take that RMD before you roll over your retirement account from your employer. So we were talking about instances where, maybe that's one of the next things. We'll come back to this. So 75 is the next age we want to talk about. You were mentioning 1960. Let's talk about
right. So if you're born after 1960,
1960 or after,
right? 1960 or after, including 1960. That was some language that they had to clarify.
Yeah, just for clarification. Right?
Yep. When it's time for you to take RMDs, that age will not be 73. It'll be 75.
Right.
So
that's not always the best strategy to wait until you're required to take distributions,
right?
Because it can push you into higher tax brackets as your retirement account grows and grows, and then could push you into higher RMDs.
Yeah, your life expectancy didn't get longer because the federal government allowed you to wait 2 years.
Well, I do think that's part of the reason we have been stretching this later and later, because people are living
Generally.
longer and often working longer. We've talked about as well. But yeah, I know what you mean. Yeah. All right. So here's the other age 75 tidbit. Let's say you work and with your employer, and you've stayed working, and you're 75.
Even part-time here, if you're still with that same employer.
And let's say it's 403B for starters. Okay. You could arguably say, I don't want my distribution requirement because I'm still working, and it can be waived. You could do the same thing if you're a part of a 401k, as long as you're not a 5% owner, like we were talking about.
Right.
So you might have the opportunity to defer, essentially, put just not have to take your distribution requirement while you're working. So I had this recently, a gentleman who had worked into his distribution requirement ages.
Sure.
And just recently retired. And so he hadn't been having RMDs from his work plan. But he stopped working last year, as it turned out.
Okay.
So this year, he has to take an RMD from his work plan. And he was looking to roll it over. And they're saying, hey, well, we would like to, but you have to take your RMD first. So that was one call, one transaction, another call, another day to deal with the rollover. Sure. Whether it's IRA, traditional, or whether it's Roth, that kind of stuff. One other thing, just as a noteworthy, in those circumstances, if you have company stock in your plan, that's part of your plan, it's worth reviewing whether you're eligible for NUA, net unrealized appreciation. Is that not net unappreciated assets? I think that's what it is. So you have a company stock. You may be able to withdraw that stock at its basis have it be taxed at the basis, not the full value, and then have capital gains treatment on the remainder of whatever it's grown into,
which is less typically.
which is a less tax rate.
Mhm.
Capital gains rates are lower than income tax rates. So sometimes that's appealing to do. Most times I would say it's appealing to do. So we've talked about that. We had a great episode on that once before.
We had an entire episode on it. And it's another one of those things that people make these moves, because that's what they think they should do, and they really miss that one-time opportunity to do it.
It's worth paying attention to. And again, this may be one of the reasons you want to work with a good financial advisor. They know the nuances of some of these dates and some of these rules, and these are helpful sometimes. So I don't know if I went back to everything we wanted to talk about there, but I think there was something I was going to mention at age 75, but I think we covered most of it. What other dates? Any other dates we should be thinking of?
I think that's enough.
It's funny. So listen, as you think about these issues, remember that sometimes it's worth having good financial counsel. We often mention the Vanguard study about the value of good financial advice. They're talking about portfolio management, and we're adding to that they say that could add as much as 3% per year by good portfolio management. Let's add to that good financial planning could add even more. As much as there's a cost, there's also a benefit, a value. So find yourself a good fiduciary financial advisor to work with. And if you need any assistance in that process, don't hesitate to reach out to our firm. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901 or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.